Our case study today focuses on Mr. D.I.Y, Malaysia's leading home improvement retailer. Over the next few minutes, we'll be analyzing how this company's financial and strategic decisions have fueled its impressive growth and operational scale, and how sustainable that model really is in the face of market volatility and competition. Before we dive into the case, allow me to introduce the members of our team. We have Ashraf, myself, Tayangku Nur Kalisa, Imbiswan, Niroshini, and also Yogeswaran. First, we will start off with some industry overview. The home improvement and retail sector in Malaysia and the Asian region is experiencing significant growth. This surge is driven by rapid urbanization, the rise of remote work setups, and the growing DIY culture among consumers. Post-pandemic, e-commerce and convenience have become top priorities, and that has reshaped how people shop for home essentials. By 2028, the Asian home improvement market is forecast to hit $14.2 billion, highlighting vast potential for players like Mr. DIY. Next, we will go into the company's background. Mr. D.I.Y is at the forefront of this transformation. From humble beginning in 2005, with just one store in Kuala Lumpur, the company has grown into Malaysia's largest home improvement retailer with over 1,300 stores nationwide. Its appeal lies in three key pillars, which are its accessibility, affordability, and varieties. Whether it's a major city or small town, Mr. D.I.Y ensures essential products are always within reach. Next, we will discuss on the purpose of the study. So, this case study aims to dive deep into what's driving Mr. D.I.Y's remarkable growth. We'll evaluate the company's core business model and its aggressive store expansion strategy. We'll also examine how Mr. D.I.Y keep costs under control while scaling operations and how it manages financial risk through its capital structure. Ultimately, we're looking at whether this growth is sustainable in the long term. To explore this in more detail, we'll focus on four key themes. First is the impact of rapid store expansion and the risk of market saturation. Second is how Mr. D.I.Y balances its low price strategy with maintaining healthy profit margins. Third, how operational efficiency supports profitability at scale. And finally, how the company builds financial resilience to navigate economic volatility and evolving market conditions. So next, Ashraf will walk us through the literature reviews gathered on this study. Over to you, Ashraf. Thank you.
First, I will touch base on the financial performance review here. So I segment into three parts here. The argument here involves analyzing a company's financial statements and key performance indicators. How do we interpret this? Ratio analysis as foundation for financial performance analysis, computation and examining specific financial measures, pricing and cost control strategies. Now, the critical analysis here is number one is the debt to equity ratio and debt to asset ratio, asset turnover ratio and inventory turnover ratio, and efficiency business operation and financial management. On the capital investment and funding sources, here are the key points. Internal financing, using retained earnings or reinvesting profits. Debt financing, issuing bonds or taking loans to fund expansion. Equity financing, raising capital through stock issuance or venture investment. Merger and acquisition, acquiring competitors or complementary business for rapid growth. The second point is the revenue growth and profitability analysis. Expansion should lead to higher revenue streams, but financial planning ensures profitability. So, for example, break-even analysis. It determines how long it takes for expansion costs to be recovered. Return on investment (ROI) measures profitability of expansion efforts. Cost-benefit analysis evaluates whether the financial gains outweigh the risk. Expansion strategy refers to a company's approach to growing its operation, market presence, or revenue streams. In financial terms, this involves capital investment, funding resources, risk management, and profitability analysis. Expansion comes with financial risks, including market volatility, operational inefficiency, and debt burden. Company uses diversification, expanding into new markets or product lines to reduce dependency on a single revenue source. Hedging strategies, managing currency or interest rate risk in global expansion. Liquidity management, ensuring sufficient cash flow to support growth without financial strain. Cost efficiency refers to the ability of a company to maximize output while minimizing costs, ensuring optimal use of financial resources. It's a key financial metric used to assess profitability, operational effectiveness, and resource allocation. Company measures cost efficiency using various financial indicators like cost to revenue ratio, which is evaluates how much cost is incurred to generate revenue, operating margin, measures profitability after deducting operating expenses, return on assets, assess how efficiently assets generate profit, and cost per unit determines the expense of producing each unit of goods or services. Capital structure refers to the mix of debt and equity that a company uses to finance its operation and growth. Financial stability refers to a company's ability to maintain healthy financial conditions and withstand economic fluctuation. What is the importance, right? The well-balanced capital structure can optimize a company's cost of capital, enhance profitability, and minimize financial risk. The composition of debt and equity affects a company's risk profile and its ability to manage financial challenges. What is the strategies for stability? Number one is the risk management. implementing strategies to manage financial risks and ensure liquidity. Scenario analysis, basically like evaluating different financial scenarios to prepare for potential market changes. Optimal leverage, maintaining a balance between debt and equity to avoid over leverage and financial distress. Talking about the definition, the ability of a company to grow its revenue, profits, market share over the long term without compromising its financial health or depleting its resources. Strategies that enhance a company's value over an extended period, benefiting shareholders, employees, customers, and the community. There are a couple of key factors, key strategies here. Number one is the resource efficiency. Right, basically is utilizing resources efficiently to minimize waste and reduce costs. Innovation, talking about continuously innovating products, service, and process to stay competitive. Market adaptability, being adaptable to market change and consumer preference. ESG is the basically talking about integrating environmental, social, and governance factors into business strategies. Strategic investment, basically investing in projects that and initiative that promise sustainable returns. Stakeholder engagement, building strong relationship with stakeholders to ensure the support and trust. Risk management, identifying and mitigating risks that could impact long-term performance. Sustainable practice, implementing sustainable practice that ensure the company's operation do not harm the environment or society. So what is the interconnection here, right? So point number one is financial performance. Sustainable growth and long-term value creation are interlinked with financial performance. Companies that focus on these aspects tend to have better financial health and resilience. Next is the investor confidence. Investors are increasingly looking for companies that demonstrate a commitment to sustainability and long-term value creation, as these companies are perceived to be lower risk and more likely to deliver consistent returns. By focusing on sustainability and long-term value creation, companies can ensure their growth is not only profitable but also responsible and resilient. Now, pass along to my next presenter. Thank you.
Let's begin by looking at theories that underpin Mr. D.I.Y's capital investment and growth vision, which emphasize evaluating long-term investments through tools like NPV, net present value, and internal rate of return. Mr. D.I.Y applies this approach when assessing major projects such as a new store opening or infrastructure like its automated distribution center. Secondly, we can see ENSOF metrics. ENSOF metric actually explains that about the company's growth strategy through both market development by expanding across ASEAN and product diversification via brands like Mr. Dollar and EM Top. Thirdly, we can see capital cycle theory, which reminds us of the risk of overexpansion. So Mr. D.I.Y mitigates this by focusing its investment in underserved or high growth areas, avoiding saturated markets. Finally, we can see growth equity model, which illustrates how Mr. D.I.Y reinvests profits into technology and scalable initiatives. This focus and shows that it is a disciplined zoom on sustainable growth at reasonable cost. You also can see on operational efficiency and profitability that firstly on cost volume profit analysis, which helps the company to comprehend on how pricing cost and also sales profit impacts the profitability. Their bulk purchasing and lean concept model actually aligns closely with their theory. And Porter's value chain model classically explain on how Mr. D.I.Y extracts value across its operation, from centralized procurement to optimized logistics, both driving the cost while maintaining the service quality. KPI and also demand forecasting, I would say, is to use to manage performance metrics like GM ROI and also inventory turnovers. These tools ensure stores are well stocked, markdowns are minimized, and profitability is protected. Finally, you can see on human capital development, which supports on the company's investment in employee training. A well-prepared workforce enables a consistent performance across its rapidly growing store network. Lastly, Mr. D.I.Y's resilience in the volatile market is shaped by strong financial principles. We can see here the first one is financial risk management theory, which is evident in the company's conservative balance sheet. So low debt, strong liquidity, and also stable earnings. This financial discipline helped the firm actually to endure challenges like inflations and also supply disruptions. While scenario and sensitivity analysis enables proactive planning, response to shifts in customer demands, currency fluctuation, and also operating costs. Economic mode concept buffer or buffet, as introduced by Warren Buffett, is seen in Mr. D.I.Y's competitive advantage. I would say its scale, pricing power, and brand strength make it like hard for new entrants to compete. And last but not least is about contingency planning and liquidity access, which ensures that the companies are maintaining sufficient reserves and also financial flexibility. This protects operations and supports strategic decisions even during the market downturns.
Up next, I will be presenting our analysis of Mr. DIY's strategic decisions across three key areas: the capital investment and growth, operational efficiency, and financial resilience. Together, these show how the company scaled quickly while maintaining financial stability. Since its IPO in year 2020, Mr. DIY grew from 593 to over 1,400 stores, which is a 142% increase in just 4 years. This expansion was powered by smart capital investment, like its 100 million ringgit Malaysia fully automated distribution center in Meru Klang, projected to break even in 2 years. Following the pecking order theory, Mr. DIY relied internal funds, reducing its net gearing ratio to minus 6.81% by year 2024. This reflects strong financial discipline. However, signs of saturations are emerging, which revenue growth slowed from 32% in year 2022 to just 6.7% in year 2024. That signals a need to shift from rapid expansion to strategic recalibration. Despite the scale, Mr. DIY has improved operational efficiency. Gross profit margins rose from 42.6% to 47%, driven by supply chain automation, private label products, and the launch of Mr. DIY Plus, a format combining multiple brands to cut costs. This aligns with the Porter's cost leadership strategy, offering low prices without sacrificing profitability. However, net profit margins have plateaued around 13%, partly due to rising staff costs and depreciation. This suggests scaling operational costs must be better managed. Using the DuPont framework, we see that ROE growth have been quality driven. From year 2020 to year 2024, the net profit margin rose from 11.5% to 13.1%, showing strong cost control. The asset turnover improved from 1.1 to 1.23, reflecting better use of asset. However, the equity multiplier dropped from 2.1 to 1.65, reflecting lower leverage. This means Mr. DIY's ROE is driven more by operational efficiency than that, which is a sign of sustainable quality growth as the company merges. In terms of resilience, the company has performed well despite inflation and weaker consumer spending. With Ringgit Malaysia 132 million in cash and minimal debt, it is insulated from interest rate shock. The financial year 2024 dividends of Ringgit Malaysia 472.9 million, which is the highest ever, signals strong cash flow and investor confidence. Looking ahead, Mr. DIY must pivot from aggressive expansion to sustainable growth, focusing on store productivity and regional diversification. Its strength lies in operational excellence and financial prudence, but future success depends on adapting to a maturing market. In short, Mr. DIY has built a solid foundation. Now it must evolve to stay competitive.
Hello all, up next I'll be presenting on the recommendations. In today's saturated retail environment, Mr. DIY must shift from aggressive physical expansion to a strategy focused on strategic diversification, digital transformation, operational excellence, and capital structure optimization. First, store productivity must take priority and must, instead of expanding footprint, Mr. DIY should localize data and analytics to optimize store layout, product assortment, and customer flow. This will boost average transaction values and revenue per square foot. Second, digital infrastructure investment is also an important key. AI, machine learning, and IoT can enhance logistic procurement and marketing, enabling dynamic pricing, personalized offer, and better demand forecasting. Improving omnichannel features like real-time inventory and click and collect also bridge digital and physical gap and increase customer convenience. Third, Mr. DIY should adopt regional diversification, focusing on Asian markets like Philippines, Vietnam, and Indonesia. These markets will align with its low-cost model. On the financial side, Mr. DIY could reintroduce moderate long-term debt to fund major investments like tech upgrades or international expansions, leveraging its low-risk profile to optimize WACC. Finally, a residual dividend policy would balance reinvestment needs to investors' confidence, paying dividends only after fund high return. In short, by integrating digital tools, improving operations and expanding strategy and optimizing capital, Mr. DIY can strengthen its competitive edge and lead the next wave of Asian retail growth. In conclusion, I would like to say that Mr. DIY's rise from single store in 2005 to over 1,400 to FY 2024 reflects strategic scalability driven by cost leadership, disciplined financial management, and operational excellence. Strong gross margin, efficient supply chains, agile IT system showcase its dynamic capabilities and resources based strength. However, the recent signs of plateau growth signals a shift into maturity phase of its life cycle. So to sustain, Mr. DIY must evolve beyond the expansion. I would like to say that the metrics shows healthy returns from operational performance, not leverage, but a lack of strategic repositioning may risk stack. And in short, Mr. DIY's foundation is solid, but future success depends on moving from growth through innovation to stay competitive and profitable in the decade ahead. That from us, thank you and have a nice day.